Have you noticed that when a company announces what seems like good news, like a store opening or a buyout of a rival, an increased profit or some cost savings, you then see the share price tank? This also seems to work in reverse, that when it seems like bad news, the share price increases. Well, in this video, we'll try and discover why this happens. I'm Anthony, and we're talking money. Benjamin Graham, who was an economist and proponent of value investing, said in his 1949 book, The Intelligent Investor, that in the short term the market prices a share like a voting machine, but in the long term it's a weighing machine, i.e. its true value will be reflected in the stock price in the long run. It's worth noting what this phrase actually means because it really does fundamentally answer why shares move as they do. Now, have you ever had a pay rise? I'm sure you have. How did you immediately feel after you were told? I can guarantee that you probably felt one of two things. You either felt flat or depressed because the pay rise was not as high as you expected, or you were elated because it was surprisingly good. Your immediate mood is analogous to how the market reacts when a company announces a piece of news which on the face of it is good news. The pay rise in your instance, or the reports of increased profits for a company, is exactly the same, and the effect in the long term is the same, but your reaction, or the market's reaction, is totally dictated by what you expected immediately before the announcement. Looking at an example, let's have a look at Beazley Insurance. It's a Lloyd's name, a Lloyd's insurer. It recently announced record losses, announced that COVID claims were going to be an extra hit on the bottom line. On the face of it, it looks really bad news. Well, what happened to the share price? It immediately went up by 17%. What on earth happened there? Well, to delve a little bit deeper, you'll find that the market was expecting a lot worse, and the company's bad news was actually much better than what analysts and brokers were thinking. Another example is GlaxoSmithKline, the pharmaceuticals giant. They reported just last week. Sales were up 1% overall. Profits of the group were up a massive 21.3%, and new drugs were being approved in the US and the EU. On the face of it, it wasn't a bad set of results, but shares immediately went down by 6.5% on the announcement. The reason was that the market was expecting better sales growth and better profits, and the announcement, although positive, fell short of expectations. Also, with a forthcoming split in the company coming in 2022, a threat to the dividend payout, or the level of dividend payout, just added to the negative sentiment. So short term in this instance is the immediate reaction to the news you've just heard. Your emotions and feelings of elation or disappointment is your vote as to whether you approve or disapprove of the announcement. Someone else might vote differently, but in markets, prices move with the crowd, so if more people are feeling disappointed, they vote accordingly and the price moves down as they sell down the stock. Now roll on 6 months, you've forgotten the immediate feeling of what you felt when you heard about your pay rise. The extra money that you got every month means that you're able to buy that new car, or send your children to football classes, or start that side hustle that you've always been meaning to start. Your overall wealth and well-being 6 months on is undoubtedly greater, and you're worth more. Again, take the analogy with the market. The share that initially disappointed the market because it did not come up to expectations has benefited from that cost saving or new factory opening, and the company has benefited from that initial announcement. The company is undoubtedly a bigger, better company, and fundamentally it's worth more than before. Markets can be slow to see new increase in fundamental worth. After all, that's why the price-earnings ratio fluctuates so much throughout the year, but eventually markets will price the share accordingly based upon its fundamentals. This is the weighing machine stage. So what do markets actually value in the short and long term? Well, this is purely my view, and if you think differently, put them in the comments below, as I'm sure you might have a different opinion. But for me, markets react up or down in the short term based upon the discrepancy between what the market expects and what the company delivers. So this could be an earnings announcement, a fire at a warehouse, a court case, or the demise of a competitor. In the long run, the market adjusts up and down according to book values, dividend yields, earnings growth, cash flows, comparisons with other shares, asset classes, and other fundamentals like that. Daily or even hourly movement is the sparring between short and long-term views. It's that continual voting weighing machine in action. Out of this, daily noise of ups and downs appears the trend that develops over weeks and months, in my opinion, it's the trend that represents the weighing machine side of the market, and the daily fluctuations is the voting element of the market. Now, you may have an opinion different to me on this, so if you do, again, put them in the comments below. It's always good to see what other people think. But anyway, I hope you've enjoyed this short video. Subscribe to the channel if you haven't already. Click on the notification bell and give it a thumbs up if you have. It really helps the channel out. But until the next video, I'm Anthony, and as always, we're talking money. Bye for now.